Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Li Auto Inc. Annual Report. Li Auto Inc. is a leading player in the energy vehicle market in China, specializing in designing, developing, manufacturing, and selling premium smart electric vehicles. The company offers a range of products, including multi-purpose vehicles and sport utility vehicles, catering to diverse customer needs. In addition to its core business of vehicle sales, Li Auto Inc. provides various services to support its customers. These include sales management, after-sales management, technology development, and corporate management services. Furthermore, the company also offers manufacturing equipment to other businesses in the industry. Li Auto Inc. operates through both online and offline channels, making it accessible to a wide customer base across China. With its headquarters in Beijing and a history dating back to 2015, Li Auto Inc. has established itself as a prominent player in the Chinese energy vehicle market. Li Auto Inc. maintains a market capitalization of $152 billion, broadly in line with the industry peer group. Li Auto Inc. trades at a higher price-to-earnings ratio of 120 times and a higher price-to-book ratio of 1.81 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 56% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On one hand, revenue growth is primarily driven by the launch of new products, expansion of product portfolio, enhanced investments in AI for product development, increased market share in China's SUV market, and sales conversion improvement. Additionally, the company's efforts to expand its sales and servicing network, accelerate the build-out of supercharging networks, and enter high-potential overseas markets have also contributed to revenue growth. On the other hand, revenue decline is largely attributed to a decrease in vehicle deliveries, which resulted in a 23% drop in vehicle sales revenue. The company's product mix has also led to decreased vehicle margins, further contributing to revenue decline. Furthermore, the relatively stable other sales and services revenue could not offset the significant decline in vehicle sales revenue, resulting in a total revenue decline of 22.3%. The net income of the company experienced a significant decline between 2024 and 2025, with a staggering drop of 85.8% in RMB terms and 86% in USD terms. This drastic reduction in net income is mirrored by a decrease in profit margins across various categories. Gross profit margin decreased from 20.5% to 18.7%, while operating profit margin plummeted from 4.9% to -0.5%. The most striking decline, however, was observed in net profit margin, which dropped from 8.05% to a mere 1.17%. These changes are largely attributed to a decrease in vehicle deliveries, resulting in lower revenue and gross profit. The shift in product mix also contributed to the decline in vehicle margin. Although increased research and development expenses had some impact on the results, it was minimal compared to other factors. The overall effect of these changes resulted in a substantial decline in net income and profit margins, indicating a challenging period for the company in 2025. Based on the provided information, it is clear that the company has been generating positive operating cash flow in recent years. In 2024, the company reported an operating cash flow of $205,249, which is a positive indicator of its financial health. Furthermore, this trend continues into 2025, where the company's operating cash flow increases to $166,907, also a positive figure. This consistent generation of positive operating cash flow suggests that the company has been able to manage its expenses and generate sufficient revenue to cover its operational costs. As a result, it is reasonable to conclude that the company is generating positive operating cash flow in 2025. The company's debt level has undergone significant changes over the past year. While total borrowings increased from RMB 8.4 billion in 2024 to RMB 9.5 billion in 2025, this growth is largely driven by a substantial increase in short-term borrowings, which rose from RMB 181,102 to RMB 6,217,745. Conversely, long-term borrowings decreased significantly, dropping from RMB 8,151,598 to RMB 3,299,203. In terms of interest expenses, the company has experienced a slight decrease. Interest expense dropped by RMB 19,677 from 187,755 to 168,078, representing a minus 10.3% change. This reduction in interest expenses is consistent with the overall trend observed across multiple pages, including page 146, which reports a decrease from minus 51,818 to minus 33,547. The company's dividend payment history is a notable aspect of its financial performance. A review of the extracted summaries reveals that the company has consistently paid dividends over several years. The presence of yes in multiple sections, including pages 13, 23, 131, 132, and 84, confirms this trend. This suggests that the company has prioritized returning value to its shareholders through dividend payments. Concerns about inventory buildup and supply chain disruption are valid based on recent data. The number of items in inventory has seen a significant increase, rising by 567,835 from 2024 to 2025. This surge is not limited to finished goods alone. Raw materials and work in progress have also experienced a substantial rise of 824,836. Furthermore, the company's inventory write-downs have increased, indicating that some of these excess items may be becoming obsolete or difficult to sell. The trade payable for raw materials has decreased, which could suggest that suppliers are being paid more quickly, but it may also indicate that the company is struggling to manage its cash flow effectively. These trends raise concerns about the potential for inventory buildup and supply chain disruption in the future. If not addressed, these issues could have significant consequences for the company's operations and bottom line. That concludes the financial summary for Li Auto Inc. Feel free to comment below, and I will be happy to answer them when possible.